Welcome to The Explainer. Today, we're going to break down how a professional analyst dissects a company for a long-term investment. And our case study is a fascinating one, Trimble Inc. We're going to walk you through the exact 5-step playbook to figure out what's really going on inside this business.
Okay, so let's jump right in. Now, this might just look like another Silicon Valley tech building, but what's happening inside is a fundamental shift, a huge business pivot. Trimble's been around for a while, but what they're doing now is totally reshaping their future. And it all boils down to one very important number. And that number is $2.39 billion. That figure is the engine behind their entire transformation. See, instead of just selling you a piece of hardware one time, Trimble has gone all in on subscriptions. That $2.4 billion is annual recurring revenue, or ARR. It's that predictable, steady, month-after-month income stream that investors absolutely love. So to really understand if this is a smart investment, we're going to follow a pro analyst's 5-step playbook. We'll look at their big pivot, then we'll ask if the business is built to last, we'll follow the money, try to find the company's true value, and finally, we'll read the signals the market is sending us. All right, first up, let's really dig into this fundamental shift in the company's DNA. This is not some minor adjustment, you guys. It's a complete reinvention of how they make money.
And this did not happen overnight. It's been a slow, deliberate, multi-year strategy. I mean, they started out back in '78 as a GPS hardware company, but over the last few years, they've been strategically selling off those old-school businesses to focus on software. And now, look at that. Subscriptions make up almost 70% of their revenue. And that recent AI acquisition, that just shows they are doubling down big time on this software-first future. Okay, so the new business model sounds great, right? But is it defensible? I mean, a great idea is pretty useless if your competition can just swoop in and copy it. So let's talk about how Trimble protects its turf.
And that brings us to the million-dollar question. For any long-term investment, you have to find what investors call a moat, like the water around a castle. It's that durable, competitive advantage that keeps the competitors, at the gate. And here's where Trimble's moat becomes crystal clear. It's the incredibly high cost of switching. Imagine you run a huge construction company and your entire operation runs on Trimble. To leave, it would be an absolute nightmare. You'd have to retrain your whole staff, somehow migrate decades of project data, and totally redesign your workflow. It's just too painful and expensive. This creates an incredibly sticky customer base, basically locking them into the Trimble ecosystem. And this slide just illustrates their strategy perfectly. While their competitors focus on just one piece of the puzzle, like Autodesk with software or Caterpillar with heavy equipment, Trimble is building the whole shebang. They're creating this complete, closed-loop system of hardware and software working together. It's a vertically integrated solution that is really, really hard for anyone else to copy. A great business with a wide moat is one thing, but we also got to check if the people running the show are making smart moves with the money. Are they being good stewards of capital? Let's follow the money trail. And wow, management is making some really bold statements with their actions. Get this, last year they spent more money buying back their own stock than the company actually generated in free cash. That is a huge bet on themselves. It screams that they think their stock is cheap. Add to that, they're selling off the old stuff, their profit margins are climbing, and they're keeping a lid on debt. All very positive signals. And here's a little plot twist in our story. You'd think a subscription model would mean super stable, gushing cash flow, right? Well, Trimble's free cash flow has actually been going down for the last 3 years. Now, this isn't necessarily a red flag. It could just be the growing pains of making such a massive transformation. But it's definitely something you'd want to keep a close eye on. So, we have a strong business and confident management. But that brings us to the most critical question of all for an investor. What's the actual price tag on this company? Are we getting a bargain? Or is the market already overpaying for all this good news? Before I show you the number, we have to understand this concept, intrinsic value. We don't really care about today's flashy stock price. What we're trying to figure out is the company's real, true, underlying worth based on all the cash it's going to produce for the rest of its life. And here we go. Based on our analysis, we calculate the intrinsic value of Trimble to be around $44 a share. But look at where the market has it priced today, $65. That is a huge gap. It tells us the market is incredibly optimistic about Trimble's future. Maybe too optimistic? Now, check out how sensitive this valuation is to the assumptions you make.
To get a value that justifies today's $65 stock price, you have to plug in that optimistic scenario, a blistering 15% growth rate. What that means is the market has priced this thing for perfection. There is very, very little room for error if they're going to live up to these expectations. All right, for our final step, let's step away from the spreadsheets and look at the market itself. The stock chart isn't just a bunch of squiggly lines. It can give us powerful clues about investor psychology and what might happen next. So, what story is the chart telling us? We're looking at this chart through a specific lens called Elliott wave theory. Now, the core idea here is that markets don't move randomly. They move in predictable, repeating patterns, or waves, that are driven by the natural rhythm of human psychology, the swings between optimism and pessimism. And this table breaks down that story for us. So after that big, powerful run-up that topped out around September 2024, the theory suggests the stock is now in a larger three-wave correction. It's labeled A, B, and C. And it looks like we've just finished that first big, painful drop, which is wave A. Okay, so according to this theory, we're right here at the bottom of that first drop. The forecast suggests we could see a short-term bounce, a corrective rebound they call wave B, up into the low 70s. But, and this is key, after that rally, the theory predicts one more final push down, wave C, to find a true bottom somewhere in the mid-50s before this whole correction is finally over. Which brings us right back to the essential question this whole analysis leaves us with. Is Trimble a great company at a risky price? The business pivot is fantastic. The competitive moat is legit. But both our fundamental valuation and the technical chart are screaming the same thing. The market has already priced in years and years of good news. And that's the dilemma for any investor today. It's a high-quality business, but how much are you willing to pay for that quality?